and then also in the context of TNT. And what a double dip is really taking advantage of the same trade twice. And in other words, getting into the trade, taking profit, getting into the same trade again at more or less the same price or better than you got into the original entry, and taking profit for a second time. And this doesn't occur all that often, but what I'm going to do is give you one illustration, or one or two illustrations. And the first one I want to give you is on this trade here. Alright, so we had a trade entry. This is an E75 trade entry. Top Bollinger Bands, you can check that one off. Trend line, you can tick that one off. Overbought stochastic, trend line break, stop loss in order. So all of those things are correct. Then we get this trade, and the trade entry here is around 94.85, and it goes down to 94.50, thereabouts. And let's say we took 30 pips on this trade. Let's just say we might not have taken the whole 30 pips. We might have waited for retracement, but we probably would have taken 20 or 30 pips. Then this trade moves sideways for quite a long time, and what happens, and yes, this is outside hours, but it doesn't really matter because I'm just using this as an illustration. The trade then moves up to test, and this is the key thing, to test the underside of the trend line that we originally sold the trade at. And you can see what happens here. This is the great part about this double dip, is that we again get another entry set up over here. We get through the Bollinger Bands, overbought stochastic, and what happens is we get this dramatic reversal, spike high, followed by a bearish engulfing candle, and the stop loss within bounds, and we manage to get the opportunity to enter the same trade off the same trend line for a second time, and in fact on the second occasion make a whole bunch more profit. So I'm going to go through several examples of double dipping on the 5-minute charts on E75, and then we'll have a look at some on TNT. Right, so here's an example of a trade, beautiful setup, perfect E75 trade, but on the initial break of the trend line, there's a problem in that we would not have been able to get into this because this 5-minute candle moved down so rapidly. But then we get the double dip. In this case, we didn't manage to get into the original trade, but then we get the double dip. We get a retracement back to the underside of the trend line, and in fact we're able to get into the trade at an even better price than we would have got in if we closed beneath. So we could have got into this trade at around, I don't know, 94.45, and we could have got in with a stop loss of 30 pips and been able to get into a trade that we weren't able to get into before. Right, here's another really good example. I've just drawn this trend line a little roughly, but you can see on this occasion, again, we had the piercing through the two Bollinger Bands and oversold stochastic, but then on the trend line break, the stop loss was way too large. And you can see then as things progressed through the day, we actually managed to come back down through the trend line, which was resistance, now becomes support. And you can see, in fact, that, okay, let me just move this along. You can see, in fact, that we came all the way back down to very close to the trend line and the Bollinger Bands, etc., and we would have been able to get into that trade on the double dip, in other words, the second occasion, and get into that trade, which is now permissible because of the stop loss, and then take advantage of the upward trend. Now I'm going to give you an example of a trade where you could have got into the trade and got out for a profit and then got back into the trade again. And there was a good example I had a little bit further on here, which I might have lost. I might have to just pause this for a moment. Alright, so here's another example of a trade that actually went really well. There was the entry. Once again, we've got a trend line break at 98.70, stop loss of about 25 pips. We had stochastic divergence, which is cool, at the low Bollinger Bands, and so on and so on. We get the trend line break around here. We then get a move all the way up to 99, 0.05, so that's about a 35 pip move. I would have wanted to go for 40 pips or more, but sometimes one doesn't get that. In fact, we would have had to get out for about 20 pips after that spike high. The chances of getting it on the top are very slim, of course. But then we get this move back down, all right, down to 98.70 again, and we can get in to the trade either there at 98.70, which is the original entry price, and then we get this support level that's formed here, and you can get into the trade there, or you could have got in after this bullish candle, but it would be much better to get in here simply because of the stop loss and so on, and then you get another bite at the cherry for the double dip. So first trade went up 35 pips. Let's say we took 20. Comes back down to support, the original entry price, same area, and then we can move up again. And in fact, in this case, the second trade went up about 50 pips. So there's potential to take, let's say we took 20 there, 70 pips from the same trade in what we call a double dip. Now I'm just looking at one currency here, that's the dollar yen, but if I had to look at more days and go through the euro as well, because we trade mainly the euro and the yen, we would find many more examples of the double dip, and we've also experienced it very often in the trading webinars where people have double dipped and done well. Or instead of double dipping to get extra profits on the trade, what people do is they wait for the retracement back to the trend line or a retracement lower in order to get in with a much smaller stop loss, and that often works really well as well. All right, so that's a double dipping on the 5-minute charts based on E75, and what I want to do now is go across to TNT and talk about double dipping there, because now this has a whole completely different level. I'm actually looking at all the charts. This has a completely different significance when you're trading TNT, and there's some pretty exciting ways that you can use this. So once again, I'm just going to take a little break, and then let's get into that. So right, on an hourly chart, this becomes a really exciting technique. And what I'm going to try and show you is, in fact, there was a good example yesterday, which took place outside our hours, and we managed to get a little bit of profit from the trade, but in fact, I'm not going to use that example because that was a real messy day. But what I'm going to try and show you here is, for example, where we get into a trade, and there are plenty of examples that abound. We get into a trade, basically this is how it works, and we get into a trade, enter a trade, that's the first step. Then we take profit on the trade at some stage, and let's say we were buying, all right, enter the trade, we take the profit, and I'm going to try and draw a schematic here. So we get the move down, we get the reversal, we enter the trade, we take the profit, it comes then back down to that support or that level or even a trend line or Fibonacci level, and we get another reversal, another good sign of reversal taking place more or less where we got in, or slightly above that, and we can get back into the same trade again, and we can take profit on that trade one more time. So in fact, with this technique, you can get into one trade, wait for it to come down again after taking profit, and then have a look again at the same reversal candles. We're looking for the same sort of thing, a no-brainer, with a tiny stop loss or a dramatic reversal at the same level that we got in originally, that you can get into with a low risk, and then get into the same trade again. So let's have a look at some examples, and I'm just going to really skim back here again, because we will find plenty of examples. Right, let's have a look at this one. And what I'm going to try and do is get the pen out again. All right, so here's the example, and again I'm going across sort of a day and a half here, because this is the best way to deal with it. But there's a piercing pattern, right? That's a piercing pattern, and we get into the original trade at, let's put the price on there, this will be easier. So we get into the original trade on that piercing pattern, It's not quite a perfect piercing pattern, but again, this is for illustration, at 35.40 roughly, 35.40, and the move goes all the way up to the high of this is 36.21. So let's say on that trade we were able to take, it went up 80 pips, but let's say we took 50 pips or 60 pips. And then a bit later on in the day, a little bit later on, we come all the way back down to the same level that we got into the original trade, right there. And then we get another reversal. We get two candles, two spike lows, and we're able to get into the same trade that we got into after confirmation that the support is going to hold. All right, so we got into the original trade, took some profit, we come back down to that level, and we see that that support level right there has held and is confirmed by two more reversal candles. We can get back into that same trade, and we can go all the way up to 60, 80. In fact, this one went up to like 100 pips or so. So that's the double dip. So we've taken 50 or 60, we can take 50 or 60 again. So out of the same little movement, we can get 100 pips plus. All right, so that's just one example, and you'll see on an hour chart this happens quite frequently. I'm going to try and find another one for you. All right, so there's another example. There's the move up, get out of the trade, but it's a day later, and we get another bullish engulfing candle, and it moves higher. In fact, I'm not even looking at the highs here. There's another example, an entry there, a beautiful entry, short to whatever profit level you took, and it comes back up to exactly the same level. And normally what we're looking for is for the trade to come back to that same level of resistance or support, and then we get another confirmation with a no-brainer. There's a big no-brainer, big bearish engulfing candle. You can get in with a small position size. It's a big chance of that winning. And so the first trade went there, got in, took profit. Second trade, exactly the same level, got in, take profit. And the same move from the same resistance or support line has created the opportunity to double dip the trade. Now this you'll find happens an awful lot on hourly charts. And okay, we've had some massive moves recently. It often happens in more range-bound sort of markets. So let's see if we can find something here. There's another example, really, but that one didn't move very far. And in this market, we'd be looking to sell, I guess. I'm not sure what the weekly direction is. But we're getting these massive moves of 300 pips in a day, so it's quite difficult to find this. I'll show you some examples on a smaller time scale. All right, and this you can actually do this intraday. Now let's have a look at this example here. I was talking about a slightly longer term pattern, but you can say you can use a slightly shorter term period. There's a reversal pattern, and that moves up about, 30 pips. And let's say for some reason we took profit there. Then we're waiting for a move down, and you can see this one's actually moved down to that same support level, spiked up, no chance to enter the trade. And we move down to more or less the same support level there, and we get another big reversal candle, and we're able to get back into that same trade again. Often the second trade, the second reversal off that support is often bigger. Okay, so you get into the first trade, take a little bit of profit, not sure about it, get out. You're just not sure about it, and you jump out of the trade early or whatever. Then the second attempt at breaking through that support, particularly if we get a move through the support. In other words, we just go beneath there, and that's a support line which has now been broken, but it reverses dramatically back up from that support level. Often the second move is the strongest. So let's have a look again in a sort of intraday scenario where we would be trading intraday, and there's another example really, but that's not clear. Some of these patterns you'll find, look at this move. We've gone 700 pips in just a couple of days. This really is, these markets are really crazy. There's another example perhaps. If we were buying down here, there's a small reversal candle, and we move up, take some profit, then we get this big bearish engulfing candle, and then another confirmation there that this support is going to hold. You can see that support goes quite a long way back. Again, just a spike through the support, little false break, and then the second move, that's this one here, is more dramatic. So that often happens. There's another example here. There's the entry signal. There, we got this piercing pattern candle. We move up, maybe take profit there, maybe get out of break even, whatever it is. That's quite a nice move. Comes back down again, and we get another reversal pattern there, right there. And the second move is always, not always, but often stronger. Let's have a look at some more examples. And more experienced traders will have done this often, and they'll know exactly what I'm talking about. And you'll be able to pick these up as time goes on. There's another example where we get this nice reversal down and a nice profit opportunity. Then we get this big bullish candle, and you think, okay, well, I got out at the right time. I took profit, and I'm all set up for the next day. And then we get this big bullish candle, and then we're followed by this massive bearish engulfing candle. And what that means is this trade is going to continue on downwards. Let's get back in again. And you can see there again, the second move, the strongest. Here's some more examples. Get in over here. Again, I'm not sure what price level that is on this reversal, 26.70. We eventually amble up to about 50 pips, 27.20 thereabouts. Even 26.70 up, yeah, about 27.20, 50 pip move. Comes back down again, comes back down, and get another little reversal candle there. You can get in again, and you can get in and out through the day if you're nimble and quick on those trades. There was more of a ranging market. Yeah, once again, there's another example, but probably not quite as easy to spot. Here's another great example. There's a trade there. Get in at I don't know, 2600 or like 2590. Moves up. Let's say 2600. It goes all the way up to 2650. There's a 50 pip profit in that trade. Then it drops back down again. Another false break of support. Have a look at that. There's the support. Get the false break through the support. This often happens. Watch for the false break and then the big rejection from the support. And there's the second move. Much bigger than the original move. It's always the second wave in a move that's the biggest. Remember that. Second wave, and Elliott wave theorists will concur with that. There's another example. Bullish piercing pattern. Into the trade, maybe take some profit, maybe get out of the trade at break even. Another chance to get back in right there on the bullish engulfing candle. And again, the second wave of the move is the biggest. So this is really double dipping. It can be a little scary for some folks because you're not sure about it and you're inexperienced and you can't read the candles. There's another one. Move up from there, move up, either take profit or whatever. These are quite big moves. They look small, but they're massive because the whole chart scale is thrown out by these big moves. And then down, there's the double dip reversal trade. Second move, the biggest. Let's have a look at one or two more examples if we can find them. Here's another good example. There's the entry signal, a nice doji reversal candle. We get really quite a big move up. Again, it looks small on the charts, but in fact that goes up from 27.70 to 28.30. So that's a 60 pip move. It looks like nothing, but it's because it's compared to these massive moves that we see on the charts. 60 pip move, then it comes back down again, bearish engulfing candle, and then we get this reversal to go back long again. Double dip. Second move, much stronger than the first one. We can have a look even on the top of the trend here. We get a reversal to short. We get a big move, either out of the trade or move stops to break even or trail the stops. And we get another big move higher, and then the second move down. Bang! Massive move after having pierced that support, resistance rather, again with this false breakthrough, big rejection, and then this move down. This is a fantastic pattern that you can use to double dip. Okay, it's the first move to get a decent profit. The second move comes back to the same, the retracement comes back to the same resistance or support. In this case, it's resistance, and it gets rejected violently. And then the second move, the second push, the second wave always much bigger than the first one. So keep an eye out for these. These are really, really good opportunities to trade and to take profit from the same trade twice, and to really rely on the second move being the largest. You don't always get the second move. You don't always get this double dip opportunity, but often you do. There's another example. Sell, take profit, and then another reversal. That one didn't actually pierce the resistance, but got right back up there again. Look at this move down, 34 to 28. 600 pip move in a matter of a couple of days. Let's look for one more example, and then I'm going to wrap this up. Excuse me. Well, there's a great example actually. Into the move. This is over a longer period though, over a full 24 hours. There's the initial entry all the way down here. Then we out of the trade at some stage. Then we get the move up, the false break through the resistance. I'm going to put that to the actual top of that candle. False break through the resistance, and the swift rejection from there. And then the second wave takes a long time to develop, but when it does, it's certainly fairly dramatic. All right, so I think that's enough examples on that, and I'm going to now wrap this video up on the double dipping and try and get these videos out to you as soon as possible, because it's now Friday afternoon, and I want to make sure you get these videos for the weekend. So I'll speak to you soon.